And oops. Oh, back here. Okay. Um, also, I would just ask that if you're not speaking, keep yourself on mute. Please use the chat for any questions during the presentations. We'll try to get to them either at the end or as we go, depending on the cadence of our presenter here. And then I'm just going to take a brief moment and introduce Fair Credit Foundation. We are a nonprofit here in Salt Lake City, Utah. Our mission is to teach individuals and families how to manage their finances wisely to improve and sustain financial well-being. We accomplish this through a variety of services and programs aimed at providing economic mobility to Utahns. So we have free one-on-one financial coaching, we have debt management plans, IDA, which are match savings accounts, financial education in the community, in addition to webinars like this one that you're attending today. And we have a program called Credit Gazelle to refinance payday loans. So with that, we don't have a whole lot of slides today. What I'm going to do, this webinar is a little bit different from our normal ones. I'm actually going to turn the time over to my friend Ben, who is here with us today, who will take us on our financial planning journey. This webinar is a two-part series, today and tomorrow at 4 o'clock. And without further ado, Ben, I'll give the time to you. Do you want to share your screen? Should I stop here?
I don't have anything on my screen that's different, so.
Okay, well, I'll leave this up like this and
yeah,
like I said.
Let me see if I can see the different people. So we have 8 people on the call, it looks like. So let me just introduce myself to the group. I own a financial advisory practice in Murray. I've been doing this for 20 years. So it's been an enjoyable career for me. And when I first got in the business, I really didn't know about this industry very much, but I quickly gravitated to the educational component of financial advice. And I ran a tutoring business in Washington, D.C. for several years before moving to Utah. So my heart is in education, and I appreciate the opportunity to be here today. So I work with lots of people, young, old, wealthy, and barely getting by. So there's a lot to talk about. Everybody has different financial needs. And my job today, and just in general, is to help people figure out some constructive ways to navigate their particular situation. And the point is to meet people where they are based on their circumstances. And there's a lot of discouragement out there. And so when we're talking with people who are discouraged, we've got to be thinking, how can we remove that? How can we move forward? But so some people will be making ends meet, some people won't. But what I thought I'd do today is go through an exercise that I go through with virtually everybody I talk with to help them create some basic foundation or a framework so that they can look at their finances very easily and get a sense of where they are. So I'm going to be introducing 5 things. This is kind of the world according to Ben, but it's very typical, but at least it gives a framework. So the first thing that, and these are, in my opinion, in order of importance. The first 3 are what I consider to be essential. And then number 4, and those could be done like right now. Maybe if you're lucky enough, all of them are in place right now, and we can focus on number 4 and number 5. in most cases, most people don't have them. And so we kind of talk with them. So I put number one as income. And I put that as number one is because if we don't have income, it's very difficult to have a serious conversation about financial planning. It really starts with having some money coming in. So if you have no income, then we move the conversation in a different direction. And all of you are welcome to call me individually, and we can talk about where we might go if you don't have income. So we first want to get a sense of cash flow, assuming we do have some income coming in. We want to get a good understanding of what is happening with our cash flow. We bring in $1,000, and is it $1,000 going out, or 1,200? Is it 800? So a lot of times people think, well, I'm making ends meet, as long as I'm not being kicked out of my apartment, I should be okay. But a good way to get a sense of whether you're making ends meet. And so the goal of number one is to make ends meet. So a good way to figure out if you're making ends meet would just be to look back over the last year or two and get a sense of whether your debt has increased or not. It's not an absolute rule, but as a general rule of thumb, if you've been kind of paying your bills and getting by and you're not being, evicted or anything, and maybe last year you had $5,000 in consumer debt, credit card or car loans or something, and now you have 10,000, then that might give an inkling that you might be running negative cash flow. So part of the income is the debt management side as well. So we want to get a sense of where's our debt. Is it credit card debt, which is extremely punitive and can eat anybody alive? Is it student debt? Is it a mortgage? Is it a car payment? Each of those is going to have different characteristics, not all of which are particularly bad. Obviously, a lot of people have a mortgage, and these days mortgage interest rates are very low, and it's often a tax deduction. So not all debt is necessarily that bad, but we do want to get a handle on that. So goal number one is to make ends meet. It's a group, so I want to ask everybody if they're doing that. But I'm going to say half the people at this point are saying, no, I'm not making ends meet. And half the people are saying, yes, I am making ends meet. Okay. That's been my experience, is that half the people at this point kind of divide. For the purposes of our discussion, I'm going to assume that you are making ends meet, even if it's just barely surviving, but you are basically getting by. If you're not, please give me a call. My number is 801-706-4968. That's my cell phone. You can call me anytime. And we can talk about that, because if you're not making ends meet, ultimately there has to be some either increase the income or decrease the spending, But we can talk about when it might make sense to go back to school and some of these other considerations, right? So let's assume that we're basically making ends meet. Are there any questions, by the way, before I just chime on? I see chat. Ellen, would you mind monitoring the chat to see if there's...
Absolutely. No questions in the chat yet, but I did
Okay.
put your phone number.
Okay. So any questions? No? Okay. So number two is insurance. For me, this is a personal preference, but I do put a lot of weight on insurance because it's so hard to get by as is. The last thing we want to have happen is to have in one moment, a catastrophic event that ruins us for life would be worse. But, you know, things can happen that can set us back for years. I believe, Ellen, correct me if I'm wrong, but I believe health, you know, bankruptcy on medical bills is by far the leading cause of bankruptcy. Some of that, not all of it, but a lot of that can be avoided with proper insurance. We all know of stories when a young parent dies and there's no insurance, you know, so that is something that is avoidable with some just inexpensive term life insurance. We've got car insurance, right? Liability. In the state of Utah, about 10% of drivers are uninsured. And so if you're, you know, driving home from work tonight and you get in an accident, you know, 50-50 chance it's you that's at fault and maybe the other person. But if the other person's at fault, you know, there's a 10% chance there's no money there. And if you're not properly insured, and let's say the person is just carrying the minimum limits, you know, 25, 50,000 or something, I think we could all agree that you could rack up $100,000 medical bill in a car accident really fast, right? So we want to be thinking defensively. So I would say in order of priority, it's medical insurance, health insurance. It is life insurance if you have dependent children. Now, if you don't have any children, if you're single or you're an empty nester and the kids are growing up or something, I really think life insurance at that point just becomes kind of an extra. But particularly parents of young children, we want to prevent a multi-generational catastrophe. You know, with mom or dad dying is bad enough. And oh, by the way, now we're poor. And, you know, so I would say life insurance if you have dependent children, just the cheap, you know, term stuff. Then you've got long-term disability.
Hey, Ben, just
Yeah.
real quick, would you mind explaining what term life insurance is?
So there are two categories of life insurance. There is one that is very inexpensive, that's term life insurance. So you take out a life insurance policy based on your current age for a certain term, a certain amount of time. So say you're 30 years old, you take out a 20-year term policy. So you lock in that rate as a 30-year-old because insurance rates get higher as you get older. So you lock in that rate and you pay $100 a month for the next 20 years. And it's like rent. As long as you're paying that, you're covered. The minute that you stop paying it, you're not covered. So that's the basic, that's just the cheap, inexpensive stuff. And generally, unless you have some, you know, serious, you know, condition, then that's typically pretty inexpensive. Now, some people say, oh, I have diabetes, I have some heart condition, life or insurance is very expensive for me. I get that, and I think the conversation becomes a little more difficult there, but I generally would recommend that people trust the insurance company to make a calculation about their probability of dying sooner rather than later. This is what insurance companies do. So if a healthy person is $100 a month, but you're, you know, unhealthy or a smoker or something, and now for the exact same person, you're $250 a month, you'd say, wow, that's just so expensive, I can't afford it. Well, keep in mind, the insurance company, they've done this with millions of people. They know the data. Your chances of dying are 1.5 times or 2.5 times greater. So you may not be able to afford as much, but just because it's expensive don't rule that out and don't say, well, it's too expensive, I won't do it. It's like, no, all the more reason, do something, because, you know, so that's term. The other is permanent insurance, and that's like whole life insurance. That's much more expensive. And really, for most people, it's not even a factor. So thank you.
There's a
Very good
question in
Yeah.
the chat on this. So will the rate stay fixed once you sign up, or increase as you get older, I think is what they're getting.
It becomes more complicated on the permanent insurance, and it does tend to increase over time. But what I'm talking about here and recommending is just a basic, stays the same. And that's why you typically, I would say, let's say you're mid-20s and you're married, no children, and you're thinking of having kids. What I would say, when you start thinking, hey, we're gonna start having children, get the policy, and then you would typically, maybe 20, 30 years, the thinking would be, I want to pick up an insurance policy that will last until the youngest child is an adult. Because then, let's say you have a policy until you're 55, and then it expires. And then if you to pick up new insurance at that point, it's very, very expensive. So most people just let that lapse when they're 50, 55 or something like that. But by then the kids are grown up. Now I'm 57 is my age. My youngest is 21. And I think my life policy expires in 3 or 4 years. And so I can say, hey, I did my duty. If I die and my kids are 25 years old, they at least can survive. We just want to avoid that, leaving young toddlers. But in answer to the question, that should be locked in for sure. Yeah, and if it's not, you've got the wrong policy. That's by definition, that is what a term policy is.
One
Very
more
good
quick question on that, Ben. How would someone find a reputable policy? I know as an employer, Fair Credit has one, and employees can sign up for additional coverage through Fair Credit's policy. Personally, I know that I don't participate in it, but my credit union often sends me in the mail solicitations to sign up for a policy. I get all kinds of ads. I think that I haven't ran a race in a long time, but I used to run a lot of races, and I would get all these solicitations. If you can run a 9-minute mile, you can have a bazillion-dollar policy for something. So, is there a good way to vet?
The thing is about term policy, all the insurance companies are going off the same actuary data, right? So they're all roughly going to be about the same because they're going all off the same data. All other things being equal, you would go with a reputable, and they're credit rating agencies. But typically your insurance agent, State Farm, I come from a State Farm family, mine's with State Farm, Bear River Mutual, Northwestern Mutual, all of these are reputable companies that would be fine. Now, Ellen, you did raise this idea about the company. A lot of companies, a lot of employers have a group life insurance policy for, say, 1 year, $50,000 or something, or your 1 year salary or something like that. And so a lot of people think, oh, I have life insurance, but when I say get life insurance, the number is 1 million, 500,000, 2 million. It's not 50,000, because again, 50,000 is better than nothing. Don't get me wrong, but 50,000, it varies. That's nothing. That's nothing. So we definitely want to get that number up, 500,000 at least, I would say, unless you really have some illness or for some reason you couldn't do it. Yeah. Any other questions on insurance? I could talk about insurance all day. I love insurance. I like to be defensive about, like, I can sleep better at night. Some people, not as much. Oh yeah, by the way, the third one is long-term disability. That one it's a little harder to come by if you have an employer that pays that on their menu. You should thank them. It's a really nice benefit. Some have it employer paid, some have it employee paid, and sometimes you just have to go get it on your own, which is kind of a hassle. But your chances, I think, frankly, arguably worse than dying is a situation where you have a young parent who gets a permanent brain injury. And now, not only they've gone from being a wage earner to now they're a financial liability to the home. And they're just cognizant, aware enough to realize I'm being a financial burden to the family. I can't get a job. I don't have all my faculties. And that's just, I can't, the amount of emotional challenge that would be, it'd just be really incomprehensible. And you can insure against that type of thing, brain injury, blindness, these types. It's not common, but there are things you can do. So that's that one. And then the last one is your liability limits. That's your renters, homeowners, car insurance. You definitely want to have a conversation with your agent, or you can talk with me. I know all these things. I love insurance. Again, I don't sell insurance, but it would be a conversation with your insurance agent to make sure you have not the state minimums, but at least maybe 100,000 or something, some policy, both that you're insuring yourself and you're protected with uninsured or underinsured motorists, something like that. Any other questions about insurance? Those are the 4 or 5 insurance categories. Okay, so number 1 is income, number 2 is insurance, number 3 is estate planning. And estate planning, I think, is something that all of us on this call today could knock off within a few days if we wanted to. Of course, it would be best to hire an attorney, an estate planning attorney, to help you with these things. But that might be, $1,000 or $2,000 or something. I don't think, if you have lots of money, great. That's a good way, do it right. But I think for most people, I'm not sure that that's really necessary. But those things would be your basic will. In fact, just when we started, I had a phone call from a client who is, he's getting up on years, but he's trying to do something for his grandchildren, and he's trying to understand how he can, give them each a little money when he dies, right? That's an estate planning concept. I'm not an estate planning attorney, but I can have that conversation, pretty far if anyone has some specific questions, and I'm free, right? So it's expensive with the attorneys because they charge by the hour. So your healthcare directives, that is a state form in the state of Utah. You just could go to, I don't know, it's like you could Google Utah state healthcare directives form, and it's a standard form. So literally within a few minutes, you could fill that out, sign it. Now, and you want to keep a copy and maybe give a copy to a loved one, a trusted person, or maybe 2 copies. And I do recommend I have, literally under my bed, very old school, I have a folder that says, in the event of my death or something, important papers. And so stuff like that is in that little thing. And then I have it in another place. So just something to say, look, if I'm incapacitated, I want my wife, I want my son, I want my dad, I want my sister-in-law, whatever, to handle things while I'm incapacitated. So you have healthcare directors, you have a living will, you have powers of attorney if you're incapacitated, who is calling the shots. You have a basic will. You have potentially a trust. That's when it would be advisable to hire an attorney and do that right. And that might be a good thing. That can be, we can have a separate conversation about trusts. But Another thing that I do actually is I have typed up just some notes to my children in particular. Just some notes like, hey, here are my bank account. Here's my 401k account. I have an insurance policy at such and such company. Here's the account number and here's their 800 number. You know, if I die, call this. Oh, here's our agent. It's Uncle Paul. You know, just call Paul. He'll take care of you. I've written down some funeral instructions, things that are important to me that I want or don't want in my funeral. I also have typed up, hey, you know, should I pass away? And right now, my children would get a lot of money because I have this life insurance policy, right? So, you know, financially, my kids, you know, might be wishing that I die here before that policy lapses in a few years. But I said, look, if I die, you guys are going to have all this money. How should you manage that? Who should you turn to? So, you know, call Grandpa Smith. He's good with money. He'll take good care of you. Blah blah blah. So I think that costs nothing. It is not difficult, and it is something that each of us on this call can do. And you could maybe make it a goal by Sunday. Sunday's the 1st, right? No, Sunday's the 31st. So you'd say, hey, walking into November, I want to be able to say that this is done, or by Christmas, or by Thanksgiving, or by the new year. So you walk into 2022, and we've got all these papers lined up. That is something that theoretically would cost no money, and it is one of the 5. Like, you're knocking off a big thing that costs you no money. And a lot of times people get discouraged because they say, oh, I've lost time. I don't have any money. I'm feeling behind the 8 ball. This is something that you can do. You can stand tall, look yourself in the mirror and say, you know what? I'm doing what I can. I'm doing what I can to make my financial affairs in order. Any questions on number 3 on estate planning stuff? No? Okay, so those are the 3 that I want to emphasize is kind of do not pass go, do not collect $200, get those things done. Then I draw a line, and for the rest of the time, we'll talk about number 4 and number 5. Because those are kind of forever. Theoretically, if you're making ends meet, you're properly insured, and you have your estate planning, those are kind of done. Number 4 and number 5 are forever. Number 4 is your liquid savings, and number 5 is your long-term illiquid savings. So number 4 is cash at the bank. It might be like if you have a safe and you have $1,000 of cash in your safe at home, or you know, a few gold coins or something like that. It might be, if you have some extra money, it might be a brokerage account that you have the money invested. But the point is that money is easily, you know, you can get to it very easily. That's your immediate cash savings. So for many people, all they have is just the checking account. We have $800 in our account, and you know, so if that is the case, then we want to focus on building up number 4. We got to build up that emergency cash. We'll talk more about that in a minute, because I have found that is extremely difficult to do for me. And so you have to be realistic about your ability to build up savings in number 4. I talk with a lot of people, and I'm amazed at how many people have money in category number 4 just sitting at the bank. I have found it very difficult to have any money sitting at the bank, because there's always a claim on every dollar. And if it's not me, it's my wife, or it's my kids, or it's something, you know. But it's interesting, like I work, with some people that have a lot of money, and then I'll go to their house, and I can remember one time I walked up to the house, the door knob is broken, the doorbell doesn't ring, and they have $1 million sitting in the bank. And I'm like, if I had $1 million sitting in the bank, I would probably fix my door handle, But there's probably a reason why they have $1 million in the bank and I don't, because they don't spend it on fixing those sorts of
Well, at
things.
least it wasn't in their house for someone to walk in and steal.
Yeah, it's really funny. So I think if you know yourself well enough to know that realistically you cannot save money, there are just too many demands, or you have just a disposition to spend what you've got. That's being honest. And so what, in that case, you want to at least make sure you focus on number 5. And number 5 is your long-term savings. Your long-term is your 401k, IRA. It could be a business that you own, a little small business or something. It could be real estate, for sure. Real estate falls in that category. So assets in number 5 are not liquid. So I talked with someone yesterday, and they were able to get into a home at 0% down earlier this year. And so they bought this home, and it's already appreciated $100,000, right? And they're freaking out because home prices are just going off the chart. So they say, hey, let's buy another one. But they don't have any other savings. They just have a few $1,000s saved up, and they want to try that again. And they said, what do you think? And I said, well, the challenge you have, just because you might be able to do it doesn't make it the right thing, because you don't have any money in number 4. There's no, what happens if things go south? And heaven knows they could. I said, I think it would just be disastrous if things go south and you have no savings. So we talked about that. But the point is kind of balancing that number 4 and that number 5. But again, if you have difficulty at number 4, then for sure at least do something in number 5. Put money into your 401k, particularly if the company is matching. So we'll talk about 5 in a second. Any questions on that so far? No?
Nothing in the chat so far.
Okay. So number 5 is really where most of your time is going to be. And so that's going to be, for most people, in their 401k plan if they have an employer that offers a 401k. So kind of the order of operations is you'd want to make sure to put in money into your 401k if the company is offering a match. If they're not offering a match, might be a different conversation. But we want to develop a 2-pronged strategy: liquidity and long-term. If you were to ask me, and my kids have heard this, all their lives, kind of rule number 1 about financial like wellness and security, and certainly the acquisition of wealth, is to own assets, to buy assets, to own assets. And what's happening in the world these days is that the rich are getting richer, the haves are getting more. So if you, like this couple right here, the fact that they were able to get into a home, they were first time, they're just a young couple, and somehow they were able to get into a home, and now they're on the train, right? They're now in motion because now they own this house. Now the bank really owns it. They don't have any equity in it, but voila, the house is appreciated. So now they have an asset with equity in it because they got on. The problem is that many people they can't get on, and the train is just going faster and faster, and it's leaving people behind. I've been producing music, and I've already written the kind of the lyrics to a song I want to produce about that train leaving the track and leaving people behind. And so if you feel discouraged, please call me. Let's figure out how you can get on the train. Somehow or other, you've got to get on the train. And this is, I think we're seeing an ugly side of capitalism. You know, capitalism has its limits. It has its good points from an economic standpoint, but an ugly side of capitalism is that the rich get richer because they're able to take that money and make more money, and it leaves most people behind. But we focus on what we do have. So let me end with this, and then we can kind of take the conversation. We can quit. I don't know how much time you wanted to spend it on, but I would say one thing that I really want to focus on is the concept of what is an asset, and to develop one's assets, to identify what our assets are, and to cultivate them and nurture them. And I want to broaden the definition of what an asset is, because if you say, oh, name your assets, and you say, well, a house, or I have a car, or something like that. Those are all very elementary, basic financial assets. But I think that we need to have a broader view of assets. And assets include your health. Assets include youth. If you're young, being young is an asset. Young people tend to be quicker, intellectually. Their brain is firing faster than older people. They recover faster. They have, I think, often a more optimistic outlook on life. They have time for money to grow. So a lot of young people say, "Oh, I don't have any assets." I would argue that a young person has more. I may have more assets in the bank, but I would argue that a young person has more assets than I do, most young people, because they have so many things. So if you're a young person and you feel discouraged, don't be discouraged. You have a lot of things working in your favor. As you get older, there are other things. You have relationships. You have, and the relationships are really important. Who are your support system? Whom can you help? Who's going to help you? How can you connect with other people to create win-win relationships and win-win outcomes? Networking. I don't know, thinking hard work is by all means an asset. If you're a hard worker, don't give that up. Work hard. Work hard. If you're smart and creative, if you're innovative, these are all assets that should not be underestimated. So I want everyone to walk away from this conversation with some thinking about what are my assets. And if you want to have a completely different conversation with me, I welcome that conversation. So we can start thinking, well, I don't have any money. I'm feeling discouraged, but I know I need to figure these things out. I would say the starting point, identify your assets, and then let's build a strategy on that, based on that. Well, thank you all. I am totally up for questions. And we can go in a different direction. I don't, we can talk about investing, right? Mutual funds and stocks and Bitcoin and all that other stuff. That's an investment discussion. Ellen, what do you think?
Well, I think let's
what
ask
time
the
is
group. So it's 4:43. So we've got some time today that we can cover some questions, and then maybe tomorrow talk more about investing? Is that kind of where you were, what your brain was doing? That's what I was thinking.
Yeah.
Great.
Right.
So
Yeah,
what,
we can, do you want to take, I mean, we can start, depending on how long people have been planning, we could start on investing, take it up to the top of the hour, end at 5. And then tomorrow, pick up on investing.
so here is, we've got a person in the chat said they'd love to cover investing tomorrow. So, and I did want to kind of piggyback on one thing that you were saying, and just reiterate, I agree 100% with everything you were saying. And I think that, you know, I agree, it's not too late. And then I think that with investing and 401ks, we have an IRA here at Fair Credit that we match. And I try to encourage everyone, you know, don't feel hopeless. Like, there's a lot out there, and the internet, bless it, can be such a curse. And I think it can make people feel really, really discouraged. If I see another Forbes article about how 23-year-olds can be billionaires by the time they're blah, 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 if they're blah, 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 and they invest this, and it's like, that's not, please don't take that to heart, and understand that, like, you can still be comfortable even if you get started late, and you can still put your foot on the right path. And there are so many resources to help, like Ben, like Fair Credit, together, both of us. And, you know, if we're both offering to help you for free, take us up.
Yeah.
You know, reach out. We have a IDA program that you may qualify to get some match money, match your savings towards a productive asset, just like Ben was saying. Because, you know, there are a lot of people that the $20 in the bank burns a hole in their pocket, so to say. So yeah.
Yeah, the very fact that people are on this call speaks volumes. The people, I've seen this pretty consistently, people who seek help and want to learn about these things generally are better off, and they're certainly putting themselves in a good position to move forward. It's unfortunate that most of the people who need to hear these basic things are not listening, they're not hearing, they're not available. That's a real challenge in our society. So the fact that you're taking a step to spend an hour on this Zoom call and to, you know, talk about these things, I think speaks very well of each of you individually, and where your heart and your attitude are. So that bodes really well. Yeah, it's many millions and millions of people achieve a very decent and financially secure retirement in the long run on very little means, with very little, just by being smart and, you know.
Yeah, and I think, you know, asking for help and soliciting resources, you know, there isn't, if finances are so tricky, and there can be a lot of stigma around asking for help, especially if you're feeling like the sole breadwinner, and, like, you know, it would be sinking low to have to admit that you don't know what a 401k is, or something. You know, please throw that thought in the garbage, because it's not, you know, nobody's going to judge you. Nobody here, at least in this call, in this space, that I know of, in, you know, the financial counseling realm that I work in. We just will be honored that you decided to reach out to us. So
yeah.
Well, I think we could keep going, but maybe we should call it a day today and see everyone tomorrow at 4. How do we feel about that?
Sounds good. Yeah, we'll see everyone tomorrow at 4.
Great. Well, thank you so much, Ben.
Okay. Thanks, Ellen. It's all everybody else. Take care.
Thanks, Ben.